the market. With that said, let's talk about the market. So if I can do this right this time, I've got screens to share. Son of a gun. Look at that, guys. I can do it.
Made it.
How about that? It's pretty amazing. Technology versus John. John wins again. So anyway, here we are. This is Freddie Mac comes out every week with their primary mortgage market survey. And what this is it's an average of mortgage rates. It's an average of mortgage rates without regard to buy downs, without regard to whether people are buying down the rate or buying or whatever they need to do. Okay. In order to get those rates. So when you see 6.26, that could include a quarter point buy down, that could include a half point buy down, that could include anything, but it's an average of all the rates. So the average of all the rates is at 6.26 for 30-year fixed and 5.41 for 15-year fixed. And if you look at the chart shows that the rates are pretty much the lowest they've been in about a year. So here we are in September 18, this was when it came out last Thursday, and rates haven't been this low since, well, let's see here, October 3 of last year. So it's been pretty much a year since we've had rates this low. So they're trending in a good way. As we all know, the Fed funds rate was reduced last week by a quarter point. So we're all hopeful. We're like, hey, all right, now they reduced the Fed funds rate, so maybe mortgage rates will start going down. Well, we all know that mortgage rates follow the 10-year bond. So let's take a look at the 10-year bond since the Fed reduced the Fed funds rate. Well, it's not going to show because it's up here. I don't want that screen. Let me get a different screen. Here it is. I'll bring this down. Okay, here we go. And why don't you know it? This is what the 10-year bond looked like in the last week. The 17th is when the Fed reduced the Fed funds rate. And what happened?
Went up.
And mortgage rates have kind of trended a little bit up too. So you're like, so why is that? What's going on? Why are mortgage rates starting to go up a little bit? Why is this happening? Well, one of the reasons why the Fed reduced the Fed funds rate was the unemployment rate. So this is what the Fed, and the Fed always says that their data, they're based on data is how they arrive. They're very data influenced. Well, this is the unemployment rate. As you can see, it's been, in the first column is what we're looking at here.
Did you mean to say that the 10-year bond's going up or the mortgage rate's going up? Because you said mortgage rates.
Both. The mortgage rates follow the 10-year bond.
Okay.
So the mortgage rates also went up. So when I showed you the chart on the 10-year bond, which was today's chart, it also showed that the mortgage rates were going up. But as you can see, the unemployment figure since the beginning of the year was 4.0, 4.1, 4.2, 4.2, 4.2, 4.1, up 4.3. So this was the data point that the Fed noticed. And when they noticed this data point, they were like, okay, we're trending upwards in unemployment. So we don't want unemployment to get too far out of whack. So what we're going to do is we're going to reduce the Fed funds rate, hoping that they're going to go ahead and spur investment by making investment cheaper, and then having more companies hire more people. Well, that's all nice, good, and that all works. But if that was the case, why are mortgage rates still going up? And it's because people are selling mortgage-backed securities. Hi, Lisa. So people are selling mortgage-backed securities. So why are they selling mortgage-backed securities? What are they seeing? Well, it's the inflation numbers. Let's take a look at the inflation numbers. So this is the CPI index. Oh, nope, this is the unemployment again. Hold on, let me get the CPI index.
Help me at all. How come I can't hear anything?
I don't know, Lisa, we can hear you. Turn up your volume. Let's see here. All right, let me see if I can share the screen. I'll be able to, but I got to move it down here. All right, try this again. All right, so the consumer price index. There it is. Okay, as you can see, the consumer price index was, let's look at it since April 2025. Can everybody see that?
Yep.
It was 2.3%. You see that?
Yeah.
Okay. So in April 2025, it's 2.3. That was Liberation Day, right? That's when the tariffs started coming into play. So let's look at inflation since Liberation Day. 2.3%, 2.4%, 2.7%, 2.7%, 2.9%. It's going up quite a bit, right? So let's take a look at the next screen I want to take a look at is the personal consumption expenditures index. Is that also up here? Let's take a look. No, that I gotta do this. This. Give me a second. I'll bring that down here. Okay. There's the personal consumption expenditures index, another key index on inflation. And you can see Liberation Day, 2.2%, 2.4%, 2.6, 2.6. So inflation is going up, and it has been going up. And as it's going up, likely as a result of the tariffs. We haven't experienced it yet as consumers because what's happening is a lot of the importers, a lot of the wholesalers are eating a lot of these tariff costs right now. However, we may end up seeing this. This is just what the data shows right now. So, why are mortgage rates maybe starting to trend upwards a little bit? Are people that are holding mortgage-backed securities thinking that the value of the mortgage-backed security would be less because of inflation, because of the rising costs of inflation? Possibly. So therefore, you may not see as many people buying mortgage-backed securities, which would then cause the rates to kind of go up a little bit. And anyway, that's what would happen. So the Fed, because the Fed only has one tool. The Fed has a Fed funds rate. They don't make policy. They don't do any of that stuff. They have one tool. So with that tool, they can either increase or decrease the Fed funds rate. They've been doing a balancing act between unemployment and inflation for a while. And this time they felt that unemployment outweighed inflation. So they reduced the Fed funds rate by a quarter. Next month when they meet, will that be the same? I don't know. We'll have to see what the CPI and the PCE is next month. And these are just a couple of the indices. They look at a lot more and a lot more data. But this is just kind of an overview or a high-level review of this information. So right now, the bond hasn't really changed much today. Rates are in the sixes on 30-year fixed mortgages. So they seem to be all right. Anybody have any comments on any of that? Okay. Well, with that said, here in Arizona, what we're starting to see as far as real estate goes, for about 6 months or so, or 6 months ago, I said, hey, it's a buyer's market. There's a lot of inventory out there. We're able to get seller concessions. We're going to be able to do buy downs. This is a great time for buyers to buy. And some people would say to me, oh, you people in real estate always say it's a good time to buy, whatever. And I'd say, well, you're true. That's true. Yeah, it is. It is. But sometimes are a little bit better than other times. And last 6 months ago, it was pretty good because there was so much inventory out there. Sellers were willing to give concessions. And we had 3-2-1 buy downs, which are like about $30,000 that sellers can put in concessions to do a 3-2-1 buy down, or 2-1 buy downs for about $20,000. So we were able to do some things to help people with their purchases. As we get into the fourth quarter, and as we get into the first quarter next year, what we're seeing here in Arizona is that it's starting to come a little bit more in balance. It isn't as much of a buyer's market. In fact, it's starting to become a little bit more balanced here in Arizona. And from the data I put together in monthly newsletter from yesterday, in California is also a little bit more balanced too. Hawaii, it looks like values are coming down still a little bit. Is that what you're seeing, Bill, in Hawaii?
Actually, I'm seeing it as basically flat, but there may be some slight small dip, but
Okay, so it's pretty much what we're seeing here in Arizona. Okay. And then Illinois is opposite. Illinois is in the Midwest and back east. It was never a buyer's market. It was always equilibrium or even more of a seller's market. So anyway, that's what we're seeing. When you get into those types of markets, more of a seller's market, you're not going to be able to get as many seller concessions, and there'll be multiple buyers and what have you. So the mortgage rates are kind of interesting though, because if the mortgage rates are around this level and we're leveling off, okay, but gee, if the mortgage rates start coming down, what do you think is going to happen? It's going to become a seller's market big time, and buyers aren't going to be able to get concessions. It'll be a great time. It'll be a better time to sell because prices are going up, and there'll be just more buyers. It's just simple supply and demand. So anyway, that's what we're seeing right now as we sit here in September. We'll wait to see what the Fed does next month. We'll wait to see what the data comes out with next month. But here in the short term, what I see in mortgage rates is we're trending. I mean, before the Fed reduced the Fed funds rate, we did come down a little bit, which that Freddie Mac survey showed that rates did come down to 6.26%. But it'll be interesting to see where rates go here in the next couple of weeks.
John,
Anyway.
last week at the Cromwell report that we had presented to us,
Yeah, the Cromford report. Yep.
yeah, Scottsdale is still a seller's market.
Scottsdale still is. Yeah.
Paradise
And there's
Valley.
certain markets. Obviously, always real estate is always local, very, very local. Different markets are different ways. And when we're talking about Arizona or Hawaii or California, I'm talking about national. And the information I use is from Redfin, which has the national numbers, but I'm sorry, the statewide numbers. But you're right. Different municipalities can be different ways and different markets. So anyway, so that's the market. That's where we're at in the market. Any questions? Any comments?
Yeah, I think with that Cromford report, one of the differences was that the luxury market was staying as a seller's market, but it was the median home prices that are falling.
Yeah, luxury market's always kind of interesting because it's just hard. You just don't know. Some of those homes, there are no comps for them. You put a $10 million home listed for sale. What are the comps? You just put it up, listed for sale, and see what happens. In some instances, and a lot of those homes at that level are paid for cash, so you're not going to get necessarily an appraisal. So anyway, but I guess it's a good time to bring up this point. Is we are in the midst of signing up with a lender who can lend up to $30 million. That's incredible. So we've got a lender that we're going to be brokering to here in the next few days. They can lend up to $30 million. They'll go up to $20 million with maybe 60% LTV. And they don't put on the rate sheets $30 million, but they can go up to $30 million. So we are going to have product for that market. And that market seems to be, we start seeing more and more transactions in that market. I've done some jumbo things, but I just want to let you know that we will be able to facilitate those types of loans. So that's pretty cool. That's pretty good news.
In AZ, or you're talking about California, Hawaii?
Arizona, California. I think it's all four of the states we're licensed in. I think they go Hawaii too. Bill, I think they go Hawaii.
that'd be helpful because
Yeah.
there is a couple of products out there I'm brainstorming right now. So
Yeah.
potential
Yeah.
client.
Yeah. No, but gee, anyway, we'll get signed up with them and we'll find out. But that's a lot. And I'm going to be I know quite a few luxury realtors, and I'm going to let them know that we've got the facility, and their local banker or their local lender may not. So anyway, and this particular lender has done homes in Paradise Valley and Scottsdale, what have you. So it's good news. It's good news for us. Let's get to refinancing, because this is a question that we're getting quite a bit: is should I refinance? Is what's available out there? Can we refinance? What have you? There are different reasons why a person would refinance. One is they just want a lower payment. So let's say, they are looking just to lower their payment. And even though their rate could end up being the same, right? Because if your mortgage balance is lower, so let's say 10 years ago you had a $300,000 mortgage balance. Now you have a $200,000 mortgage balance, but you want to refinance the 200,000 and you put that amortize that over 30 years. The rates are the same. Yeah, your payment's going to be lower. So some people like to do it for cash flow. Some people like to do it just to lower the interest rate. And we often say there's a 1% rule of thumb, but I mean it just depends. You have to take a look at the costs and you have to do a break-even analysis and see if the savings warrants the refinance. So that's another one is interest rate and break even. But there's another lender out there that kind of works on cash flow, which they're doing a buy down on refinances. It's only rate term refinances, and it's a 2-1 buy down is the max. I've got a client that's working on it's doing one of these right now because on a cash flow basis it works because they used to have a rate around 3%. On the buy down, the rate would be around 4%, but because his mortgage balance is lower now, his payment's not going to be much different. And this particular client is just coming out of a divorce situation. So it's going to be beneficial for him to for the first year, try to maintain the same cash flow while he's trying to work his way out of the divorce. So there's a 2-1 buy down on rate term refinances out there. And if you want information on it, I'll give it to you. But it's pretty good. It goes to, and I say this every month, there's more products out there today than I can even remember. It's incredible the number of products that are available to us right now. So anyway, so that's refinancing. Anybody have anything they'd like to say about refinancing? Don't be shy.
Yeah,
Remember, go ahead.
If they're old enough, they can, instead of refinancing, if they want to keep that low interest first, they can do a second reverse. So
did we share notes, Flint, before this roundtable? Because that's the next thing I was going to talk about was reverse seconds. And I actually think I forget who I was talking about that before. It was Alan.
It was me, and I got it from Flint.
Yeah. Oh, well, there you go. So yes, and that's great. So let's talk about reverse mortgages.
There's only one lender that does it.
Nah, I think there's a couple that'll do second mortgages now.
Yeah, a
Yeah.
reverse second. Okay,
Yeah.
I only knew of one.
Yeah. So anyway, when first of all, you have to be at least 55 years old. It used to be 62, but now we've got a lender that'll go down to 55. There may be a couple lenders that go down to 55. And what happens on a reverse mortgage is you need to have typically about 40 or 50% equity in your house. It's more and more closer to 50%. And you refinance your first mortgage, and the reverse piece is that instead of making payments on a monthly basis, the principal balance increases on a monthly basis. So the house, in essence, is making the payments, and the principal balance increases. As the principal balance increases over time, you have less equity in the home, and you can, as long as it's your primary residence, you can stay there forever, regardless of how high the principal balance gets. Well, some lenders have noted, and as most of us have, that a lot of people that have 2 or 3% rates are not in a hurry to refinance. So we've seen a lot of second mortgages, lines of credit, home equity loans, and now there are reverse mortgage second mortgages. And on a reverse mortgage second mortgage, the lenders will go to a higher combined loan to value. In other words, you don't necessarily need 50% equity. Maybe all you need is 40% equity because they know that you have a first mortgage that's at 3% and you're making payments on it, but they will go ahead and lend you to a higher combined loan to value than you can get on a regular first mortgage, reverse mortgage, because you are making payments on that first mortgage. So you may be able to get a little bit more equity, and it still works the same way. You don't have to make payment. You can make payments on a reverse mortgage. You don't have to. Instead, the principal balance will go up on a monthly basis, and you have to stay there as your primary residence. And even you can stay there even if it goes upside down, or the home goes upside down, you can still stay there, what have you. It's just less and less and less equity it eats in, and you'd have less to leave for your heirs if that's a consideration. But anyway, that's how the reverse mortgages work, and the reverse second mortgages. There's just a ton of products, guys. Here's another one I'm doing right now. I'm doing a no income, no employment primary residence purchase. What? Those of us who've been in the business for a while, no ratio. Remember no ratio? That's what this is. There's a few lenders out there that are doing these, and right now I only got a couple conditions left, and I got clear to close, and we're pushing through it. Rate's not that bad. It's in the mid sevens for something like this on a 30-year fixed, which really isn't that bad considering. But it's no employment, no income, primary residence. Now, or second home. Now, we know you can do that for investment property. That's what the DSCR loans are, the debt service coverage ratio loans. And those loans, they'll take the appraised value on the appraisal report, the market rents, compared to the mortgage payment. And that kind of tells you whether you can get approved for that. This loan isn't even that. There's a few lenders out there that'll do this no income, no employment verification. And it's really an asset-driven product because they still have to show ability to repay. In most instances, at least the loans I've done, the borrowers have had assets that have exceeded the loan amount. And so the lenders kind of do whatever they can in their, figuring and determining that it meets the Dodd-Frank ability to repay standard. But it's out there and it is good. It's not the lender that goes to 20 million, but you could maybe get about a couple million on these on a no income. And there's a lot of self-employed folks out there that this could be really helpful for. So anyway, it's a great product, no income, no employment. We're pretty close. I got about a week left on this before we close, and I can let you guys all know how my experience was after we close. So far, so good.
What was the FICO score requirement?
Over 700. And in this instance, we had to do a rapid rescore. We had to work with them, and we paid off a few things. We did a rapid rescore. He got his credit score over 700, and rates in the mid sevens on a 30-year fixed, which you're not showing any employment, or some guy doesn't have any employment or income, but he's sitting on some cash and he wants to buy a house, but he doesn't want to liquidate it. If he's making 10% in the market on his investments, maybe he doesn't pay cash. Maybe since he can leverage 7.5%, maybe he leverages 7.5%. And then a year or two from now, if rates get better, we refinance them if that's the case, but we'd have to wait and see. So anyway, that's just another example of more and more products that are available out there. Pretty crazy.
John, I noticed on local television this morning, Finance of America is advertising again, reverse, but they're saying 55. If you're 55 and older, contact us. And I thought 62 was the cutoff.
No. Finance of America is one of the lenders that has gone, who we can broker to, that has gone to 55. Finance of America is one of the major reverse mortgage players. But there's a couple other lenders out there that are going down to 55 now. So, yeah. Okay. No, that's good. That's good, guys. Any questions on any of that? All right. Let's talk about recasting and getting out of mortgage insurance. When we close a loan, the lender then, there's two pieces to a loan after you close. There's the actual note that gets sold, and it's usually put with hedge funds and it gets sold in the secondary market. But then there's the servicing piece too. And the servicing piece is what most of the public knows about. They don't know necessarily that the note is in Hong Kong with a hedge fund somewhere. If they were around in 07, they remembered about the short sales, they may remember that. But nowadays, they wouldn't necessarily know that. They just know that, I'm getting a monthly statement from ABC Servicing, and this is who I need to make my payments to. So some of those servicers will allow people to recast. So let's say that you're going to buy a house and you put 10% down, and it has mortgage insurance. But that maybe it's contingent on the sale of a home. That in about 6 months, you're going to get a big chunk of change and you're going to pay down that mortgage. And you're going to pay it down to 50%. But if you just make a payment of 50% down that mortgage, your mortgage payment, your principal balance goes down, but the mortgage payment stays the same. If some servicers will allow you to recast, which is a reamortization of the loan at the lower balance, so then you have a lower payment. So recasting, not every servicer will do it. So sometimes when I originate a loan, I'll call the lender and I'll say, look, do you allow recasting? And they say, well, if we hold on to the loan, we will. But they could hold on to the loan for 6 months and then their servicing department sells it and what have you. But a lot of the servicers nowadays do allow recasting.
You see what the fees are on that?
It's usually a few $100. You may have to get an appraisal.
Oh, they have to get an appraisal. All right.
maybe plus appraisal sometimes. Now, to get out of mortgage insurance, though, the Homeowners Protection Act says that if you pay down the loan to a 20% equity position, they can no longer assess you mortgage insurance. And I've talked to a few wholesalers about this in the last week or two, and they keep telling me that, well, I don't know about the mortgage. You have to deal with the mortgage insurance companies, what have you. And I just don't understand how the mortgage insurance companies can hold on to it, because the Homeowners Protection Act says straight up that if you are paid down to an 80% loan to value, you can get out of mortgage insurance. So anyway, but recasting is the issue I wanted to make sure everybody knows about. I've had loans many times in the past, and then I'll talk to the lender. I'll say, hey, do you allow recasting? They'll say, no, I can't tell you that, John, because we sell everything in the secondary market. And a lot of the lenders who we broker to that have really good rates, they will end up saying that because they pay. That's how they keep their costs down, and they just go with low cost servicers, low cost everything, and you don't know. But other servicers will. So, and of course, you could always refinance them down the road too. So anyway, so that is recasting. Now, I wanted to talk about blended rate. We talked about blended rate. Oh, any questions right now? Anything? Bueller? Nothing? Okay, that's fine. All right. So
That's good. They just approach the servicer with their own contact, or do we do that for them? Is it just a
well, we don't.
nice
Sometimes
guy?
we don't know who the servicer will be because we're brokering the loan. So it just depends on where it's sold to. But I give my borrowers that information so they know that they can, maybe that's
Okay,
something that they can.
so they make
go
their
ahead.
own contact when
Yeah,
the,
they make, yeah.
you just give them the concept. Okay, got it.
Yeah, I give them the concept, and and hopefully it'll be there for them. So, okay, I want to talk about blended rate. Does everybody know what a blended rate is? And this is important because when we're getting into refinancing, you're going to need to know how to calculate this. So let's go over this. Okay, can everybody see these examples?
Yes,
Yeah.
Okay, should I blow these up a little bit?
yes.
A little small? Okay, I can blow them up. Let's see here. Oh, that's the wrong way.
There you go. Yeah.
Let me go here. All right, great. Oh, so in the first example, so when you're talking about a blended rate, you have somebody that's got a first mortgage and a second mortgage. And they're trying to figure out, do I refinance? How do I determine whether I want to refinance or not? What would be my blended rate compared to what the rates are today? So in the first example, example A, the first mortgage is $500,000 at 3%. And they have a second mortgage of $300,000 at 8%. What is the blended rate? This is how you calculate it. Because it's in essence the effective rate of those two mortgages. 500,000 times 3% is 15,000. 300,000 times 8% is 24,000. Add the weighted interest costs, which total 39,000. Divide by the total balance of the loans of 800,000, and the effective rate is 4.875. So in this instance, they have 500,000 at 3%, 300,000 at 8%. Their blended rate is 4.875. If they're looking to refinance at 6.5% or whatever the rate is, you may say, look, you may not want to do anything right now. Your blended rate seems to be pretty good. You're probably in a pretty good spot. Let's take a look at another example. Let's say their first mortgage is 200 at 3.5, but the second mortgage is 300 at 8.5. Doing the same calculation, which is weighted interest costs. 200 times 3.5 is 7,000. 300 times 8.5 is 25.5. Adding them up, 32.5. Dividing by the 500,000 is 6.5. So in this instance, their blended rate is 6.5%. Well, if you're offering a product around 6%, maybe in this instance it is worthwhile to refinance at 6%. So it's important to know how to calculate these rates. This blended rate is available on our shared documents in our Google Drive, and you have access to it. But it's just a basic way of determining because as we go on, a lot of people are going to have these 3% first mortgage rates, but they may want to borrow and they have a lot more equity in their home because values have gone up. So does it make more sense when you're trying to determine whether you get a second mortgage or not? You can do a blended rate calculation. You can get the second mortgage rate, and the second mortgage rate may be 8%. You'll say, okay, well then let me take a look at the 3% first mortgage, and you want 400,000 on the second mortgage. What's the blended rate? Well, your blended rate would be 6.5%, 7%. Well, what can I get you otherwise? And that would help you in planning with your customers whether the current rates are something that they should consider in refinancing out of that 3% loan as compared to just getting a loan. So that's blended rates. Any questions on that? Great.
Yep. Thanks.
All right, next. Trigger leads. As you know, I'm on the board, Arizona Association of Mortgage Professionals. I'm the legislative liaison. I've been that for a number of years, and happy to say that the trigger leads bill did get approved, which means that when we pull credit, those triggers, just the simple fact of that pull, will not be sold. There is an exception if they already have a current relationship with them. If that servicer or bank already has a current relationship with them, they can go ahead and get notified. But other than that, they're not going to sell it out in the general public. That is going to be effective in March of next year. So up until then, you still may want to advise your clients to go to optoutprescreen.com so that they can opt out of any potential solicitations when their credit is pulled. But nicely, the trigger leads was passed. Trump did sign it, and hopefully it'll start taking effect in March of next year. So you wouldn't necessarily need to say, hey, look out for, all these people are going to start soliciting you after we pull your credit. Like there was an instance where somebody from the CFPB was refinancing their loan and they got contacted 87 times. That's the wrong person. That's the wrong person you want to contact. So anyway, but so what do you think may happen if the credit companies, Experian, TransUnion, and Equifax, aren't going to be able to get revenue from trigger leads? What do you think may happen to the cost of credit reports?
Going to go up.
March of next year. Exactly. So that's one thing that we know about, and that's as a unintended consequence of this, and we've already seen it over the last couple of years. Once the trigger leads bill started getting some momentum, right? What's happened to credit report fees in the last 2-3 years? They've tripled. So they've already kind of priced it in a little bit. So anyway, we'll still be watching this to see if there's going to be any changes. But son of a gun, I think that's part of why credit reports costs have gone up, because they knew that this was coming down the pipe, and that was a big revenue source that they weren't going to have any longer. That's my opinion, not necessarily the opinion of anybody in this panel or of Council Mortgage Group, since we are broadcasting this on YouTube live. All right. Any comments on that? No comments. Okay.
Yep.
Okay. Today's big news in the real estate world. Compass. Are you guys familiar with Compass Real Estate Company?
Yep.
They're going to buy Anywhere Real Estate. Anywhere owns Century 21, Caldwell Banker, Corcoran, and Sotheby's for $1.6 billion.
Holy shit.
Compass is becoming huge, even bigger. It's going to be, they've been here in Arizona for a little while now, and they acquired Launch, and then they acquired Local Real Estate, which was Walt Danley's group. And now they're going to acquire a few more that also happen to be here in Arizona too. So Compass is making more and more of impact. But the article I read was, even with this, it's still only like 25% of the market. There's so many independent, smaller real estate companies out there that make up the market. So anyway, just an interesting bit of news that was on the Wall Street Journal feed today.
I'm surprised Sotheby's is part of that deal. I mean, I thought Sotheby's was like one of the biggest ones.
Well, Sotheby's, yeah. Now Sotheby's has affiliations in each state. Like here, they have an affiliation with Russ Lyon. I don't know that Compass is buying Russ Lyon. I think Compass is buying the Sotheby's international piece. They have more of an international presence. There are real estate companies, for example, Engel and Volkers, which is local and international, and I think Compass is getting into that space. So, any comments on that? Okay. All right. Any updates? Anything anybody wants to share? Hard money, commercial mortgages, anything anybody wants to share? Anything you want to share, Alan, and hard money?
We're still, we're at 11%. I haven't seen any really movement,
Okay.
on interest rate for us. Now I know other hard money are charging, 12, 13, once in a blue moon, my lender may do a 10.5, right now, but until we really see, a big downturn, at least a
There's
half
a,
point.
yeah, there's a National Private Lenders Association conference here in Arizona at the end of this month that I'm on the fence as to whether I'll go. It just kind of depends how my work load schedule. I may stop by and meet some other of the national private money lenders. That could be interesting. I mentioned it to Alan. I don't know if he wants to go. We may want to mention it to Jeff too if he's in town. Maybe the three of us just go and walk around and see who's out there.
He's going to be actually on the 30th flying to Uzbekistan.
Yeah, so he won't be he won't be there.
Gotra told me about that. They invited me to go.
Oh yeah. Oh, okay. Yeah.
Gotra Capital, Connor.
Yeah. Well, if I go, I'll let you know. And if you go, let me know.
It's the 29th and 30th, right?
Yeah, but they sent me, so they emailed me about something on the 30th. Maybe their expo is on the 30th. So
Well, the 30th
because I'm kind of interested in that and meeting with different
is a
players.
Tuesday, so
Yeah, it's a Tuesday. Yeah. So, Mike, anything new on the commercial front?
New.
Thanks, Mike. All right, we'll talk to you later.
I gotta
I
jump
wanted to make an observation, if I could, about the
Yeah.
blended rates that you were talking about. If we can go back and revisit there.
Sure. You want me to bring up the screen?
No, that's all right. I guess to start, I'd like to make the distinction that commercial real estate is a different business than residential. Dynamics, a lot of them are related, but they're not the same. So blended rates, when you calculate them, the arithmetic is the same, but the sourcing is different. And John, you know that many times, especially in our market, we talk about commercial. We probably have a pretty good niche from, I don't know, 750,000 up to maybe, 4 or 5 million, something like that. So a lot of the investors that are invested in that market, when you talk about blended rates, you're not getting a first and a second from unrelated or disinterested parties. A lot of that second mortgage is going to be a seller carryback. They're going to be there. And so, a lot of our experience was with, is with sellers that also own a business. And so there's a dynamic there that gives you more flexibility in how we structure that. And that feeds into the primary lender that is interested in the first. Sometimes they're looking for not just appraised value, they're looking for value on a debt service basis, debt service coverage. They're looking at that. They're going to be income lenders rather than asset lenders. And so the bricks and mortar value are kind of nice to know, but that's not where the decision is made. So if you get a buyer to come in and you have a seller and he says, I want this many dollars, the assumption is you're going to put down maybe 15, 20%, maybe 30% if it's conventional. And so the seller has an interest in seeing that the deal is done. Their motivations are good. So a buyer comes in, a lot of buyers in that market assume they won't be able to get a conventional loan. They'll assume the seller's going to be doing all the financing. So if we bring a buyer in and find a first lender that is not the seller. And that first lender looks at debt service coverage, and the income statements are only going to be what they are. We can find some flexibility in meeting the primary lender's debt service coverage ratio by peeling back some of the price and giving it to the seller. Okay. Well, when you look at structuring, that puts us in a position of being able to kind of structure that second. We're not going to a disinterested second deed of trust or mortgage, if you will. So a lot of times we have flexibility in structuring that second mortgage that we can negotiate between the buyer and the seller. Okay. The obvious thing is interest rates, but the other thing that we've done, and we did one here when I was back in Arizona. I think it was one of the latter ones I did on that. What was it, golly? It was about a $5 million project up in Kingman, I think, something like
Yeah, I
that.
remember. Yep,
And
yep.
we were able to put the second in place, and we got a deferral on, I think, 1 year's worth of debt service coverage. They just amortized it and rolled it over into the principal amount, but there was no debt service coverage for it for the first year. And we got that done. So the rate is one thing, but if you're going to be able to defer payments, that's going to get into the debt service coverage ratio for the lender, which really is only interested in about the first 12 months of it. They figure if it'll season 12 months, then I'm out of the risk window, so to speak. So if we can defer those payments, that will give us a lot of flexibility in putting the deal together and getting buyers and sellers prices and things like that. And it also has a tax impact on the seller because they're not having to pay taxes on that seller carryback that they're taking because they're not receiving any money for it during the deferral period. So in commercial real estate, you have a lot more dynamics, I guess, a lot more moving targets where we can bring these numbers together to satisfy lenders' debt service requirements and sellers' sale objective, and still make it digestible for a buyer to come in. Because you can't, on commercial, you can't write the loan and look at the loan and look at the interest payments and raise those to such a degree that the tenant can't pay them because they'll go out of business.
Right.
So there's got to be a lot of consideration here, and we have flexibility in doing that in the commercial real estate market that you don't see in housing, residential, even if there's an investor involved with it. It's not a seller or what do you call it, owner occupied. Okay.
No, that's wise advice. It's a different thought process. I've always said a lot of at least the agency product, the Fannie Mae, Freddie Mac stuff, it's all square peg, square hole stuff, right? It's, you have to fit in this box. You have to have two pay stubs, 2 bank statements, blah, 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 blah. But, when you're talking commercial, it's more of the old school. Doesn't make sense. What's what are we doing
Well,
here?
it is, and even, a lot of what we did with the seller owner, where they're selling the business with the real estate. A lot of that is SBA qualified. SBA now, even in 504s, goes up to 5 million. And, excuse me, on the 7As go up to 5 million, and 504s go up to 10 million. So you can get into pretty hitty numbers. But those lenders that are preferred lenders, as opposed to general run-of-the-mill lenders, they can do their own underwriting. They don't need to go to the SBA for approval. So, that's where we had, a lot of our success in the small business market is dealing with the preferred lenders, where the lender understands the business. They can make their own judgments on it, because some of these niche markets, gas stations particularly, not everybody wants to do those. Those are perceived to be high risk markets for lenders. And so you don't find a lot of people stepping into that niche. I think there's probably other niches like that have their own following, and you need specialty lenders, and you're going to have specialty buyers. Going down the thing and looking at this and talking to lenders recently here over the last maybe couple of years, since the environment's got a little bit dicey, let's call it.
Yeah, right.
The thing they look at most is what they call the strength of the sponsor. Does this guy know what he's doing? And if he's got a good resume and he's got a good financial statement, and he looks like he can afford to lose his $1 million or $2 million, they'll underwrite it, and keep it away. It has an SBA label, but the lender will take that risk on behalf of the borrower.
Have you seen any seller carry back rates lower than the first
No.
that they've offered? Okay, because I've had some people calling me on scenarios where, I'm 11% on hard money and the seller is willing to do 8% second, and I'm going, well, we need to jump on that.
I've had some of those proposed where buyers come in and sellers look at this and say, well, gee, if I got to carry a second and the SBA is at prime plus 2, that takes it at 9.25 or so today. So the seller says, well, gee, I need at least 11%, your world.
Yeah.
And come in and look at it. And I've had sellers come in and carry seconds lower than that SBA first, because that's starting out at prime plus up to 2 3/4. So that can get pretty heady, but you can get that second loan, you can put it in there and maybe only bump it 1/4 to 0.5%, maybe put them in at 8%. But if you get a 12 to 18 month deferral on payments,
right,
that can work.
Right.
Because that, and the buyer in those kind of situations has the same risk window that the lender has. If I can make this work for 6 months, 3 months, 6 months, a year, digest the business, whatever I need to do, and stabilize it, then I can be through that risk window, and now I can afford to go in and carry that 8 or 9% second. But the other thing is, if they're using a 7A loan, those SBA 7A loans, they have no prepayment penalties after 3 years. So you can go in, the buyer can go in, digest the business portion of it, and there's an allocation of value there between what's the business and what's the real estate. But you can get established in the property, season it for that 3 years, peel out the value of the business, and go out and refinance the real estate only, and get into a conventional real estate commercial loan, which today's market's probably about 6.25, 6.5, something like that. Okay. So you kind of have to extend the horizon there, and sometimes you need to do this with both the buyer and the seller to let them understand the dynamic of it.
Right.
Okay.
And then you also have buyers you've been running their business out of there for 10 years, and they're just having an opportunity from the sellers motivated to sell the property only. They have nothing to do with the business.
Well, yeah, if you have a seller only and the business is not part of the transaction, it takes a lot of the dynamic away. There's fewer things to analyze and to look at and to extend and hypothesize about. But it's just something. Again, if you get a 10-unit apartment, something like that, that you can go into agency financing for it, and you may be buying it, but you're not buying the business per se.
Yeah.
Because the business is really just renting a bunch of houses that happen to be tied together in a box. So it's different. But I think if we're talking about trying to broker these different things for typically an investor or a buyer investor, may or may not include the business, maybe any other business. I think we have to have the opportunity that we can expand their perception of what they're selling and what's being bought, and bring different things to the table. Because the hardest thing to do is to satisfy the lender, supposedly. And so if you get a lender that you're dealing with that this type of property or business is not their sweet spot, if it's not the sweet spot and they don't understand the business, it's going to be a hard road to hoe. Because they're not going to understand the risks and how to lay them off and this and that. So most of the lenders that that I try to deal with have a favorite SIC code to deal with, and it can back here, Indiana, back here in the South Bend Elkhart area, one of the big drivers of the economy is the RV business, for all over the world. So you want to find a lender for them. That gas station lenders aren't particularly friendly to it, but we do have lenders back here because of where they're located. They know the RV business. So I don't want to take an RV loan and take it to a general lender who looks at the RV business because it's ups and downs, and you got to know how it rides the economic cycle.
You're talking about RV parks, right?
And try to get them through it, because they're not going to understand it. It's going to be a hard underwriting for them to do. But you're looking for those little niche lenders for the industries that you have.
You're talking about RV parks or RV dealerships?
No, they're making the vehicles.
Oh, the
travel trailers or Winnebago.
The manufacturers. Okay, the manufacturers.
Yeah, the manufacturers, and they distribute to dealers. Some of the bigger dealers in the RV business are back in Mesa and Glendale and Goodyear and these places.
Yeah.
So, but here's where they make them. And so, learning about those lenders and who do you distribute to, and what is the economy in Mesa, for instance.
Right.
I
know I know Eugene, Oregon's a big one too.
Yeah.
So.
I don't know them all. I'm not going to try to specialize in RVs. I just happen to be in the RV patch.
Right. Yeah.
You had your chance there, Mike, because you could have broadcast to the world there about your expertise in RVs, but.
Yeah, well, whenever, you say, if you specialize in everything, you specialize in nothing.
That's the truth. That's the truth. All right, guys. Well, that was what's on my list for today. Good. It was good today. Good topics. We went over a lot of things. Interest rates are always something to talk. It's always good coffee table conversation too. Hey, where are the rates? Where it's happening? So I always try to give you guys info so you know how to kind of follow them. And when you get in those conversations, you have some things you can rely on. For those of you who are not on video and just audio, you will not be on YouTube, because I'm looking at our YouTube feed, and YouTube, for whatever reason, just picks up the people who are on video, not on audio. You may like it that way. Maybe you don't want to be on video. But anyway, so I just wanted to let you know. So when you look at YouTube, it's just not going to show your name like it does here. It's not even going to show anything. But we'd love to see you on video, as to have you appear on these new roundtables. And it's a great marketing piece for you too. You can let people know, hey, look, we've got a mortgage company that we can do a lot of different things. And there's a lot of knowledge here, guys. There's a lot of experience here that has done a lot of things over the years. So anyway, always great seeing everybody. Have a super couple weeks. We'll see you next month in October. Anybody have anything else they'd like to add?
Will Halloween masks be obligatory for the October call?
It depends, Mike. It depends. It will be a couple weeks out of Halloween, maybe a week and a half. It's a toss-up. If you'd like to wear a mask, go right ahead.
I was told I've got a face made for radio, so I'll probably just wear that one.
Well, I think YouTube's the equalizer on that now, right? So because anybody can get on YouTube, as we've seen. So
yeah. Okay. Thank you, John.
All right. Hey, thanks, guys. We'll see you next month.
So long, all.
Take care.
Okay.
Bye-bye.